Hi, Thursday, July 7th, 2015. Monaco 64 here, home of alternative economics and contrarian views. I'd like to talk today about the law of diminishing returns and retired central bankers versus governing central bankers. The law of diminishing returns basically states that, the more of something you consume, the more return you get from it after a certain period. It's just like if you've been in the desert and you're really thirsty and you come up to an oasis and you drink water. That first glass of water is going to really quench your thirst, but after a few glasses, it doesn't have the same impact. That's basically the law of diminishing returns. And retired central bankers versus governing central bankers. I want to talk about Mervyn King, who was the governor of the Bank of England from 2003 to 2013, and he worked there from 1993 to 2013, so 20 years. I just recently bought his book called The End of Alchemy. I haven't finished reading it, but there are some interesting snippets I'm going to read from this book today. And governing central banker is Mark Carney, the present governor of the Bank of England. Earlier this week, he's part of the Bank of England's Financial Stability Report Committee, whatever you want to call it, and they came out and they slashed so-called rainy day fund for UK banks. It's some kind of reserve they have to keep for safety. And he said, oh, well, you can take that money now and use it to lend. And he cut the reserve requirement of that rainy day fund to zero, from 0.5% of the bank, all the banks, risk-weighted assets, as they call, and that resulted into a freeing up about 5.7 billion pounds, and according to Mr. Carney, that will free up 150 billion pounds in potential credit to the economy. So he's trying to bring more credit into the economy. They're blaming Brexit, of course, for all the woes of the economy right now. In my opinion, Brexit, they're using it as an excuse. I think it's the law of diminishing returns kicking in big time on the credit system. After 20 years of borrowing and spending, people, the returns on credit are diminishing because people, they've borrowed too much already in the past. They can't keep borrowing, and the law of diminishing returns is kicking in. The other thing that's coming out, and this has been directly impacted by Mark Carney, who's right after Brexit said they're gonna accommodate monetary policy more, probably cut rates next week on Thursday or do more QE. So we've had now, and I quote a story in the Daily Telegraph this morning. It says, mortgage war as 10-year rates plunge to just 2.39%. So, and I read from this article, it says the lowest ever 10-year fixed rate mortgage has been launched as lenders battle to undercut each other to attract business in an uncertain housing market. Is it really uncertain? And it goes to say here that borrowers are anxious about long-term instability caused by Brexit. Isn't it more that borrowers are up to here in debt and that they've had enough of borrowing? I tend to think so. So basically, HSBC, they've offered a fee-free 10-year fixed rate at 2.79% from today. But then within hours, there's a building society called Coventry Building Society, and they undercut HSBC by 10 basis points to 2.69%. So why am I talking about this? Well, because And why am I talking about Mervyn King? Well, I'll tell you why. In one of the initial chapters here in his book, he's talking about why central bankers in the late 90s, early 2000s, and throughout before the 2008 crisis, why they were cutting rates, especially in the deficit countries like UK, US, France. There are countries that had he's talking about the imbalance between the surplus countries and the deficit countries. And he said, all this imbalance, well, the imbalance is part of my, I quote this though, all this reinforced the determination of central banks to maintain extraordinary low interest rates. Monetary stimulus via low interest rates works largely by giving incentives to bring forward spending from the future to the present. But this is a short-term effect. After a time, tomorrow becomes today. Then we have to repeat the exercise and bring forward spending from the new tomorrow to the new today. As time passes, we will be digging larger and larger holes in future demand. The result is a self-reinforcing path of weak growth in the economy. What started as an international savings glut has become a major disequilibrium in the world economy. This creates an enormous challenge for monetary policy. Central banks are in effect like cyclists pedaling up an even steeper hill. They have to inject more and more monetary stimulus in order to maintain the same rate of growth of aggregate spending. The problem was building up well before the crisis and was evident even in the 1990s. So, as I said, it's been going on for like 20 years. It led to the lopsided growth of demand. Rightly or wrongly, central banks took the view that two-speed growth was better than no growth. And then he goes on to say later on in this chapter, and he's talking about QE, right? And he says, there is in fact nothing unconventional about such a practice, QE, as I will explain in chapter 5. So-called QE was long regarded as a standard tool of monetary policy, but the scale on which it has been implemented is unprecedented. Even so, it has become more and more difficult to persuade householders and businesses to bring forward once again from an even bleaker future. Even so, it has become more and more difficult to persuade households and businesses to bring spending forward once again from an even bleaker future. At a point, monetary policy confronts diminishing returns. And he says at the end of this paragraph in the chapter, he says, we have reached that point. So, yes, maybe Brexit brings a bit of uncertainty to the future, but according to Mervyn King, who was a head economist of the Bank of England, governor for 10 years, we've reached that point. I'm not saying, I agree with everything Mervyn King says. Some of the stuff he talks about in the book, I don't agree with, but I agree with that. Basically, we've reached that saturation point. And I don't think this is going to help. Unfortunately, as Kyle Bass and Grant Williams talked about in their interview on Rio Vision TV, which I covered a few days ago, QE is going to fail because the returns are, the law of diminishing returns are really kicking in. So the next step, unfortunately, for these crazy governing central bankers, because it looks like Mervyn King has seen the light, the next step for them could be helicopter money. And that will be something to behold. So yeah, that's where we are today in the UK, and I think the same applies for the US. The Fed will not raise rates, and if anything, they're going to do more QE, and they're going to do as much as they can to encourage people to borrow and lend. But in my opinion, they'll be pushing on the string, as Mervyn King says. you know, we've reached a point where there's been too many borrowing from the future to spend in the present. There's been too much of that, and the hole we've dug is too large, and the central bankers can't cycle uphill fast enough to get out of the hole. So if you enjoyed this video and my analysis, please like, share, and subscribe. Thanks for watching. Bye.